Hi, and welcome back to the Business Career College video series. In this video, we're going to carry on from the first video we saw concerning the taxation of life insurance, and we're going to look at a partial surrender of a life insurance policy. In the first video in the taxation of life insurance series, we looked at a complete surrender, and we're going to use that same data from that earlier complete surrender, and we're going to go through a partial surrender. So the partial surrender, here's what happens. We're going to have the same math as we did earlier for complete surrender, all the same tax consequences and so forth. And now we're not going to take the full $60,000 out because that does result in a complete surrender of the policy. We're going to take out a smaller amount. So this is a withdrawal from the policy. It's not a loan or anything else. There's no obligation to repay. We're going to have a withdrawal here of, let's say, just for the sake of argument, $36,000. So this policy owner says, I want to take out $36,000. Well, basically, all we're going to do is figure out that $36,000 is what proportion of $60,000. So you would say, okay, 36,000 out of a possible 60,000, that is a 60% proportion that's withdrawn here. And what that basically means is that we're going to reduce everything or apply everything at 60% of the rate that we would have for a complete surrender. So in the partial surrender, we're taking out $36,000, and here we're going to use just 60% of our ACB. We're going to use $15,000 here, which is going to result in a taxable policy gain of $21,000. Again, that's 60% of this figure. We'll use this same tax rate just to make a little bit of an apples to apples comparison, and we're going to arrive then at $8,400 of taxable policy gain. So the key here is simply that you have to figure out, based on your withdrawal, what proportion, so just do this quick bit of math here, based on the most value you could have taken out and the amount you actually are taking out, and that'll get you that, in this case, 60% proportion, and then just apply that 60% math to the complete surrender math that you should have already done. That's relatively straightforward. And then the next part of this would be, what are you left with afterwards? Well, your ACB is also going to reduce by 60%. Or in a sense, I used 60% of the ACB here, so I had a $25,000 ACB. I knocked that down by 60%. $10,000 is the new ACB. So any future policy transaction that would be taxable, we're going to deal with a $10,000 ACB for that transaction. It's relatively straightforward, but a lot of people do have a tough time with this math if you just apply it methodically. So the first thing you do is your math for the complete surrender. The second thing you do is figure out the proportion. And the last thing you do is apply the math that we see here, and it makes the the partial surrender much, much easier to calculate. This, by the way, is very similar to what you're going to do with a partial surrender for a segregated fund, the only difference being there that you would have a capital gains treatment of whatever your taxable gain is. Even with mutual funds is pretty similar to what happens. So I hope this helps to understand the taxation of a partial surrender of a life insurance policy. This is a place where people tend to struggle a fair bit. I hope that my method here makes it as easy as possible to understand. I hope you enjoy your continued studies. Thank you very kindly.